As we move into 2024, I'm going to start to make some changes to my wheel strategy approach. Not the strategy in general. I'm definitely going to be still trading the wheel. Just we've been talking in my Discord a lot about different strategies and ways to approach the wheel. And I think with the current conditions of the market, I'm going to make some changes coming into this year. And if you're just getting into options trading, I think this is definitely something that you need to be able to do. There is all types of trades, right? We've done everything on this channel from spreads to leaps to the poor man's covered call, all the way up to the wheel. You have to be able to implement these different strategies depending on the market conditions. And over the last couple of years, the market conditions have gone all over the place. So this is just another continuation of that as we come out of a very, very bullish, a very, very big 2023. Now we're starting to see some things kind of settle down. Q4 wasn't exactly huge, but now we're starting to see some more trends, but still in the upward direction that make me want to change my approach when it comes to trading the wheel. First and foremost, the things that I will not be trading, my general rules of thumb. Guys, I will be choosing good quality stocks. Simple as that. And you get to decide what you think is a good quality stock. But that is something that I've burned myself, and I've seen so many people get eaten up inside the Discord just trying to trade cheap stocks or inexpensive stocks, just low quality stocks, right? We need to be trading with established stocks. Now, a lot of them are on the more expensive side or going to require a little bit of capital. But don't get me wrong, there are plenty of stocks that you can be trading in any range, right? There are very, very good quality stocks that trade for $20 a share, and there's some that trade for thousands of dollars a share. But you need to decide what is that good quality stock, because if you've been following this channel, you know sometimes you're going to get caught bag holding and you're going to need to wait for that stock to recover, and you want to make sure that stock actually can recover if there is a pullback in the market. Another thing I will not be changing when it comes to covered calls, I will not be writing strikes below my cost basis. I've done it before, you've seen it, and you've seen it every single time blow up in my face. Whatever your average cost is, as long as you are writing strikes above that average cost, the covered call strategy, it is a win-win scenario as long as you're above your strike. When you start going below your strike, when things pull back and you're bag holding and you're like, then you write a strike below, something crazy happens, it gets assigned early, and you lose money on that trade. So please continue to write above your basis. And for puts, continue to make sure that you are writing strikes on your puts that are at a fair market value for that stock. If you start writing puts above what a stock is really worth, and it nosedives and it tanks like we saw in the beginning of 2023 and in 2022, you're going to be bag holding stocks at a very, very low price for a very, very low time. And the last thing that will not change in 2024 is me using my guide and journal to the wheel strategy. Yes, this is a plug for myself, guys, a full guide journal, very, very beginner. So if you have a pretty good understanding of the wheel, you may not get a ton out of this, but if you are new, I've heard the new people say that this book has really, really helped them. So you could pick this up on Amazon. I'll leave that in a link below, and that's going to be the pitch for the video. First, guys, here's a look at Robinhood and everything that I'm using in Robinhood. And I actually found out that one of my new favorite brokerages is going to introduce options soon. So we might be moving away from Robinhood. Stay tuned for that in the future, and we'll see if that actually happens. But for now, Robinhood, guys, I have 4 options open right now. I have a put and a bunch of calls. That put was on an assigned Starbucks call that got assigned a couple months back. And the stocks that I'm holding are Apple, Google, and Amazon. And right there, it kind of shows you the trend of where I've moved when it comes to my approach inside the wheel strategy. Now, last year when it comes to the wheel, I got to be honest, it wasn't an outstanding year as far as money is concerned. And I got a ton of comments like, hey, Brad, it seems like a lot of work to be getting next to nothing. Last year, guys, only returned $556 total. Average income per trade, $4. Total trades, 127 for the whole year. That was a monthly return of 0.14 and a year-to-date return of 0.156, where the S&P returned 26.3. And people are like, that seems like a lot of work. Like, why not just put your money all into the S&P 500? And I'm like, that's all my money is pretty much in VTI. And I've also said for years, and this is a great example, guys, the covered call and the wheel strategy, guys, it's a bearish strategy. It is a way to increase your income in a down market. So in 2022, if we go back to 2022 and look, this was an outstanding year for me because it was a down year. So in that year, I had a year-to-date return of almost 14%, where the S&P 500 was down 18%. So this strategy definitely does well. It's not to beat the markets. The wheel strategy is not a beat the markets kind of strategy. This is a strategy to hedge against the markets going down and also to add some income that you want to make on top of your yearly returns. My portfolio was up 20% or almost $7,000. If we go back and look at pretty much the last year, we're in mid-January now. Today is actually the 25th. So we're at the end of January. But over the last year, 21%. So the portfolio had a really good year. The wheel strategy, not so much because of that tear that the S&P 500 made. So you need to be aware of that going into 2024. If the market's going to rip, there's a pretty good chance that your portfolio, as far as the wheel concerned, it might not be that great. And the reason for me is I like to write pretty close to the money as long as I'm above my strike. So I did a ton of rolling this year. Stocks have just kept going and going and going. And we know when we roll an option, which is something I'm always still going to do. We'll see how many rolls I took at the end of this year. When you're rolling options, you're really only going to be rolling for a small amount of credit and trying to move that strike. So your gains are going to be capital gains wise, not so much premium wise, if that makes sense. And looking back, guys, we can see all these rolls, a bunch of rolls and a bunch of covered calls. I don't let anything go to expiration anymore. It's just not worth it. You get screwed at expiration. But we can see in December, it's like, where's December? And it's true, I did not make any trades in December. And this is all leading up to right now. Like, what is the new approach? The new approach is really a look at the type of stock that I'm going to be trading, but more the days till expiration. I have been a dividend stock wheel trader, and I have done weeklies pretty much my entire wheel career of now 5 or 6 years. And I found that right now, with the way the markets are acting, those are not going to get me the best premiums. We get premiums based mostly on volatility. And dividend stocks, they have a low volatility, which comes with a low amount of premium to begin with. So by going with these growth stocks, I'm going to get a little bit more volatility, and that's also going to lead to a little bit more premium. Also, by using these growth stocks, I'm able to take advantage of the growth right now in the market, frankly. And oftentimes that will return you more than the wheel can. I've always said that a good 1%, 12% on the year for a wheel strategy in a wheel portfolio is very, very good. That's kind of what I've averaged over the last couple of years, 1% a month. But as we saw, like last year when the S&P goes up 26%, you can definitely do better. So when we can combine premiums with growth in these growth stocks, that's definitely something that I want to try. But because growth stocks move a lot more quickly, both in the up direction and the down direction, I've had trouble with weeklies. It's been like a lot of rolling and a lot of like, oh man, which I never really saw with dividend stocks. With dividend stocks, really all you have to watch out for is ex-dividend dates because you'll get assigned early if somebody wants to grab that dividend from you. But the problem I'm seeing with the growth stocks, like I said, is from day to day, we're seeing jumps of 2, 3% sometimes. So what I've been doing is I've been pushing out my expiration, pushing it out further and further. And I've read in books before and talking with other traders that they love that like 45-day sweet spot. And I've always just been against it because I like trading. I like being active. I like being in front of the computer. And I like the action that weeklies provided, where monthlies were more like passive and sit back kind of. I've really only done monthlies when I was on summer vacation or I knew I wasn't going to be in front of the computer. But like I said, I like the action of weeklies. But now, since I've pushed out expirations a month, even 2 months, and made less trades, I'm making less trades, but making more premium, more money, and also giving that stock some room to breathe, both in the up direction and the down direction. So if you notice here, I had that 2-2 put, which is about 2 weeks. I tried that a little bit. But Amazon, 216. Apple, I went all the way out to April because I really wanted to get some premium and I really wanted to give that thing some room to breathe after it shot up. And then Google, which has been a saga on this channel all of last year. I have that out for next year. I kind of put that at a spot where I was going to make a ton of money. I rolled it out pretty far so I don't have to think about it. And yeah, so we'll see what happens with Google, but you're going to see me start to add more growth stocks, and you are going to start to see me incorporate more monthlies in 2024. I would love to hear what you're doing. If you trade on monthlies, weeklies, please let me know down in the comments below. I would love to get some feedback and also give the viewers somebody else to read or something else to read besides me. If you want to jump in the Discord and talk with me about it, I will leave that link down in the description below. You can get that for about a cup of coffee for every single month. And like I said, if you want to try this out, nice small journal, easy to read, I would highly recommend just picking this up. You can pick it up on Amazon. Check out the reviews there. I'll leave that link down in the description below. Catch you guys on the next video.